1. Navigating tariff volatility, the power of FTZs. 2. Warehouse conversions and industrial real estate trends amid trade uncertainty expert insights. 3. Exploring tariff hideouts, foreign trade zones and bonded warehouses. 4. U.S. foreign trade zones, how companies avoid Trump tariffs and boost cash flow. 1. Navigating tariff volatility, the power of FTZs. Imagine trying to navigate a maze blindfolded. That's what it feels like for U.S. importers right now, as they grapple with escalating geopolitical tensions, supply chain disruptions, and the ever-changing landscape of tariffs. With the current administration's unpredictable trade policies squeezing profit margins and complicating strategic planning, C-suite executives are scrambling to find ways to drive efficiencies and cut costs. And this is where foreign trade zones, FTZs, come into play, offering a beacon of hope in these turbulent times. FTZs are secure areas authorized by the federal government, typically located within 60 miles or a 90-minute drive from a U.S. port of entry. Within these zones, commercial goods, both domestic and foreign, receive the same treatment by U.S. Customs and Border Protection, CBP, as if they were outside the commerce of the United States. This Special Economic Zone, SEZ, status allows companies to defer, reduce, or even eliminate duties, depending on how the FTZ is utilized and the final destination of the goods. For instance, re-exporting cargo can help avoid applicable duties and taxes, while domestic distribution might offer different advantages. But here's where it gets controversial. While FTZs offer significant benefits, not all industries or companies will see the same advantages. Some might find the setup costs and operational complexities outweigh the benefits. So, is an FTZ right for your business? Let's dive in and explore how FTZs work in practice. FTZs serve two primary functions: as warehouses or distribution centers, and as manufacturing or production facilities. In the first scenario, products are imported into the FTZ and held there for distribution. In the second, significant transformation of items can occur within the zone. The specific use case depends on the industry, the types of products imported, and the company's trade requirements. As of 2023, there were 200 active FTZs within the U.S., handling nearly $950 billion worth of goods. About 60% of these zones are used for production or manufacturing, while the remaining 40% are used for warehousing. This split highlights the versatility of FTZs and their potential to benefit a wide range of industries. Top 3 ways FTZs can boost your bottom line. Cost savings are the primary driver for most companies considering an FTZ. Here are 3 key ways importers and manufacturers can reduce operational costs using FTZs. 1. Weekly customs entry and merchandise processing fee, MPF, savings. One of the most significant cost-saving opportunities comes from consolidating weekly shipments into a single customs entry. This approach can dramatically reduce broker entry fees and MPF charges. For example, a company making 1,000 entries per year can file one entry each week, slashing associated costs. The MPF, which is 0.3464% of the value of each entry, with a minimum fee of $32.71 and a maximum of $634.62, can add up quickly. By switching to weekly entries, a company hitting the maximum MPF on each entry could save over $600,000 annually. These savings can then be reinvested into running the FTZ, covering grantee fees, software management, and consultant services. 2. Inverted tariffs in manufacturing. Inverted tariffs allow manufacturers to pay duty on either the finished product or the individual components used to produce it within the FTZ, whichever is lower. This concept, introduced in 1934, aimed to offset high tariffs and promote domestic manufacturing. However, there's a catch: imports subject to Section 232, 301, and International Emergency Economic Powers Act, IEEPA, tariffs must be categorized as privileged foreign status, locking in the duty rate at that of the raw material and eliminating the savings benefit. Their hope is that future U.S. trade deals will revert this provision, bringing inverted tariffs back into play. 3. Eliminating tariffs for exports. Goods stored in an FTZ can be redirected for export without incurring quota charges or U.S. duties. This insulation from tariff hikes can significantly cut operating costs and improve cash flow. Additionally, merchandise exported from the U.S. and subsequently returned can be admitted to an FTZ for storage, repair, and re-export, all without being subject to customs brokerage fees or duties. Beyond cost-cutting, efficiency and cash flow benefits. FTZs offer more than just cost savings. They provide a range of efficiency and cash flow benefits, such as increased speed of delivery. With direct delivery, importers can move goods from the port or airport to their zone without waiting on a customs entry or release, streamlining the flow of goods. For foreign entities needing fast delivery to U.S. customers, holding inventory in an FTZ can mean shipping orders within a day or two, rather than several days or weeks, fostering brand loyalty and repeat orders. The timing of duty payments also makes a significant difference to cash flow. FTZs enable importers to defer payment of duties and taxes until goods leave the zone, bringing the duty cost closer to when goods are sold to the customer. This shortens the cash cycle and optimizes cash flow. Furthermore, for states that charge local and state ad valorem and/or property tax on inventory, FTZs offer a safe harbor from these taxes, further reducing operational costs. In the face of unpredictable tariffs and rising costs, integrating FTZs into the supply chain can be a game-changer for mitigating tariff volatility. While FTZs are not a one-size-fits-all solution, and companies should consult with experts to determine if FTZs are a good fit for their operations, the flexibility, cost savings, and efficiency gains they offer can be a lifeline in today's turbulent trade environment. But what do you think? Could FTZs be the answer to your tariff troubles, or are there too many strings attached? Share your thoughts in the comments below. 2. Warehouse conversions and industrial real estate trends amid trade uncertainty. Expert insights. In today's rapidly changing economic landscape, the transformation of warehouses is gaining momentum as companies grapple with the uncertainties surrounding trade. This shift is not just a trend, it reflects a strategic response to the evolving market conditions. One intriguing development is the growing interest in repurposing existing warehouse spaces into bonded warehouses. While this process can be both time-consuming and expensive, it may prove to be a worthwhile investment if tariff rates decrease in the future, allowing for goods to be released at more favorable rates. Conversely, if tariffs remain high, bonded warehouses offer a strategic advantage by enabling businesses to gradually release their inventory, thereby managing the financial pressures associated with tariffs more effectively. But here's where it gets controversial. The long-term strategy for many firms may involve relocating production of goods destined for the American market from China to countries with lower tariffs, such as Vietnam, India, and Mexico. Some companies might even consider bringing production back to the U.S. However, the imposition of a hefty 50% tariff on steel and aluminum imports could significantly hinder manufacturers' plans to establish facilities domestically. This raises an important question: is reshoring truly feasible for most companies, or will the costs prove too prohibitive? In April, the volume of imports saw a sharp decline of nearly 20% as businesses scaled back following a surge in the first quarter, which was largely driven by a rush to build up inventories ahead of the Trump administration's announcement of new tariffs. While port activity has decreased in major markets like Los Angeles, there is another wave of imports on the horizon as companies strive to stay ahead of potential future tariffs and stock up for the upcoming holiday season. According to Yardi Matrix, the industrial real estate market experienced a decrease in vacancy rates and an increase in rental prices across the nation in May. Specifically, the national average rent for industrial space rose by 6.3% year-over-year, reaching $8.54 per square foot, while vacancy rates fell by 30 basis points month-over-month to 8.5%. However, it's worth noting that this figure represents an increase of 290 basis points compared to the previous year. Miami stood out as the leader in rent growth for May, with a remarkable 9.8% increase in in-place rents over the past year. As of May, there was a staggering 342.3 million square feet of industrial space under construction across the country, with 117.8 million square feet already delivered. In total, 86.9 million square feet of new projects were initiated through May, indicating that 2024 is on track to witness the lowest level of industrial starts this decade. Yardi Matrix has long predicted that industrial starts would rebound sometime in 2026, however, recent developments pose a threat to this optimistic outlook. The ongoing uncertainty surrounding tariffs has caused many businesses to delay their leasing decisions, which in turn slows the absorption rate of newly delivered supply. Moreover, the industrial sector is facing additional challenges due to fewer than expected interest rate cuts, which have kept construction loan costs high and exerted downward pressure on new project starts. The report highlights that the most significant obstacle to a recovery in industrial starts is the 50% tariff on imported steel, which continues to loom large over the industry. In terms of transactions, the industrial sector recorded a total of $21.4 billion in sales during the first 5 months of the year, with properties trading at an average price of $133 per square foot. Phoenix has emerged as a prime target for investors, bolstered by its growing reputation as a logistics and manufacturing hub. This market saw $862 million in sales this year, with average sales prices reaching $187 per square foot. As we navigate these complex dynamics, it's essential to consider the implications of these trends. Are businesses making the right moves in response to trade uncertainties, or are they risking too much by investing in warehouse conversions and shifting production? We invite you to share your thoughts and insights in the comments below. 3. Exploring tariff hideouts, foreign trade zones and bonded warehouses. Trade wars are costing companies millions, but there's a legal loophole turning tariffs into a waiting game. As global trade tensions escalate, businesses are increasingly relying on two obscure tools to shield themselves from financial chaos: foreign trade zones, FTZs, and bonded warehouses. These government-approved hideouts allow companies to press pause on tariff payments, rewrite supply chain rules, and even gamble on future policy changes. But here's where it gets controversial. Critics argue these strategies let corporations dodge their fair share of taxes while ordinary consumers foot the bill. N born during the Great Depression's trade wars, when smoothly tariffs skyrocketed to 53%, FTZs were originally designed to stimulate international commerce. Think of them as temporary tax-free bubbles where imported materials can be stored, transformed, or combined duty-free. Picture an automotive plant in Ohio importing Chinese steel and Mexican wiring harnesses. In an FTZ, they can assemble these into finished trucks without paying tariffs until the vehicles roll out to dealerships. Bonded warehouses work similarly but with tighter deadlines. Goods can gather dust for up to 5 years versus indefinite storage in FTZs. N. Here's why this matters today. With over 2,240 FTZs across all 50 states, companies from Ford to Pfizer have used these zones to sidestep trade war fallout. During COVID vaccine development, Pfizer famously avoided import taxes on vital components by manufacturing in FTZs while awaiting FDA approval. But the real game changer was the now abolished inverted tariff benefit, a policy that let companies pay lower duties on finished products rather than individual components. Imagine baking a cake where paying tax on flour, sugar, and eggs costs more than the whole dessert. That's the financial logic Trump's 2025 executive orders destroyed for manufacturers like Regentech. N. We're suddenly paying 7% more to make road paint, explains Regentech's president Helen Torkos. It's like being charged extra for every egg and sugar packet before you even preheat the oven. This policy shift has created a gold rush for bonded warehouses, where companies now play tariff roulette. Here's the twist: unlike FTZs that lock in rates, bonded warehouses let businesses wait out tariff storms. If duties drop while goods are stored, say from 25% to 10%, companies pants to clear inventory at the lower rate. Logistics expert Jason Strickland calls it the ultimate cash flow chess move in an era of trade unpredictability. N. But here's what most miss: these strategies aren't about avoiding tariffs, they are about buying time in a volatile political landscape. As one Fortune 500 CFO anonymously admitted, "We're not tax dodgers, we're survivalists." The real question sparking boardroom debates: are these tools smart financial engineering or corporate welfare in disguise? When automakers save billions through FTZs while small manufacturers drown in tariffs, does that level the playing field, or tilt it, /N/N. We want to hear from you. Should companies bear the full brunt of tariffs immediately, or is strategic deferral a legitimate survival tactic in trade wars? Share your take in the comments, and whether you believe these century-old loopholes will survive our new era of economic nationalism. 4. U.S. Foreign Trade Zones: How companies avoid Trump tariffs and boost cash flow. Imagine a world where businesses can dodge tariffs, protect their cash flow, and stay competitive, all while operating within the United States. Sounds too good to be true. Well, welcome to the controversial yet fascinating realm of foreign trade zones, FTZs. Companies across America are tapping into a Depression-era policy to navigate the stormy seas of President Trump's tariffs. With 374 FTZs scattered across the country, from bustling metropolises to remote towns, these special zones offer a unique advantage. Goods imported here can remain duty-free until they are ready to be sold to American consumers. This means businesses can import products or materials without paying tariffs upfront, only paying when they are ready to sell. And if they export, they avoid tariffs entirely. The interest in these zones has skyrocketed since Trump's tariffs were announced in April. According to logistics firm Descartes, which helps companies set up and run operations in FTZs, interest has quadrupled. Foreign trade zones were first introduced in 1934, during the Great Depression, when tariffs were last as prominent and impactful as they are now, explains Jackson Wood, Director of Industry Strategy at Descartes. That's why they are back in the spotlight. In 2023, nearly $1 trillion worth of goods was imported into these zones, accounting for almost one-third of all imports that year. These zones employ over 500,000 people and generate significant economic activity. But how do these zones work? Essentially, they are secure areas within the U.S. where businesses can import and store goods without paying tariffs until they are ready to sell. They can range from a small warehouse room to sprawling industrial complexes. The catch? They must be within 60 miles of a customs and border protection port of entry. Take Audio-Technica, a Japanese company that produces turntables and audio equipment. They opened a second warehouse in San Diego's FTZ in June. With the higher tariffs, it gives us the ability to defer the payment of those tariffs until we're ready to sell our products, explains Dan Ratley, Executive Director of Supply Chains at Audio-Technica. It's a game changer for our cash flow and competitiveness. However, the benefits of FTZs are not without controversy. While they offer temporary relief from tariffs, the recent executive orders on reciprocal tariffs have complicated things for some businesses. Companies operating in FTZs must now pay tariffs on the inputs, like steel or aluminum, used to manufacture their products, rather than the finished product. This change has left some businesses feeling frustrated and uncertain about their future competitiveness. We have members who are very upset about losing the ability to maintain their global competitiveness, says Melissa Ehrman, Director of Advocacy and Strategic Relations at the National Association of Foreign Trade Zones. It's a major problem. Despite these challenges, FTZs remain a valuable tool for many importers. They offer a way to minimize the impact of tariffs, improve cash flow, and stay competitive in a rapidly changing global market. But the debate rages on: are FTZs a loophole or a lifeline? What do you think? Share your thoughts in the comments below.